Today we're going to take a look at a pretty interesting company that's unique for a few reasons. Their stock currently yields an impressive 34.21%, which is probably the highest for any individual company currently out there. You might be familiar with the YieldMax ETFs, which offer some of the highest dividend yields that you can possibly find in the market. Some of them offer yields exceeding 40%, and in the case of TSLY, can occasionally offer a yield exceeding 50%. But regarding these YieldMax funds, not only does it involve placing your trust in just one holding, but the dividend amounts change every single distribution. The dividends can swing up and down dramatically depending on the performance of the underlying security. But in the case of today's company, this extremely high-yielding stock has never seen a dividend reduction. In fact, they've continued to grow their dividends in our high-interest rate environment. The company I'm referring to is OFS Credit Company, ticker symbol OCCI. They're a non-diversified closed-end management company that was founded back in 2018. Its objective is to generate current income with a secondary objective of generating capital appreciation, primarily through investing in collateralized loan obligations or CLO equities and debt securities. According to their website, they believe the capacity to underwrite, analyze, and value the underlying loan portfolios of CLOs represents a significant competitive advantage. The company utilizes a methodical and rigorous investment analysis and due diligence process both structurally and on a loan level basis. Looking at their dividend history, this company has not once ever reduced their dividend. OCCI used to pay monthly dividends until mid-2020, which is why there's this big jump on Seeking Alpha's bar chart. This was actually a dividend increase, as they went from paying 17 cents per month to then 52 cents every quarter. Since their IPO 5 years ago, this company has increased their dividend a total of 5 times in their existence. It's for these reasons that OCCI sounds like a really appealing investment for people seeking current income. A $1,000 investment in this stock today would earn you about $81.95 every quarter, or for the average price of a new car in America, this stock would pay you almost $16,000 a year in dividends. But before getting too excited, it needs to be known that this stock has been suffering significantly in terms of its share price and net asset value. Since their IPO, the stock has seen its share price fall by over 60%, which is obviously a huge concern. Normally, I would just write off this kind of investment as being way too dangerous to consider. What is the point of investing in something that's going to lose a significant amount of your capital regardless of the dividend? But the more I study this company, the more fascinated I am by it. Specifically, how on earth could a company whose share price has fallen so hard not only keep its astronomically high dividend, but also continue to grow it over time? With the distributions in mind, it would be great for this company to eventually see a recovery once interest rates start decreasing. But to really understand how OCCI is able to pay this significantly high dividend, we need to know what this company does and how it earns its income. So today I really wanted to focus in on this company and try and determine if OCCI could at any time be a great investment to consider, or if it's currently a good investment to consider in the hopes of a rebound coming soon. So let's go ahead and get started. In order to understand this stock, we need to understand what kind of business OCCI is. I've seen a lot of people get confused about this holding, as some people think it's an ETF or a business development company. After all, the description of OCCI says that it holds equity and debt securities, which is what BDCs and ETFs usually hold. But OFS Credit Company is a CLO fund, and it's structured as a closed-end fund, or a CEF. First, let's define what a CEF is. Closed-end funds are different from ETFs, but again, many people often confuse the two. CEFs hold an array of investments just like ETFs and open-end mutual funds, but they do differ in some pretty significant ways. Closed-end funds are almost always actively managed, as opposed to, say, index funds, which are passively managed. They can also use leverage in order to boost returns, which ETFs and standard mutual funds from Vanguard can't. Because of this, they often come with much higher expense ratios than ETFs. Closed-end funds sometimes hold investments that differ from ETFs, which typically only hold equity securities. CEFs can hold option instruments, different types of corporate debt, and other closed-end funds. But in the case of OCCI, this closed-end fund holds something called CLOs, which stand for collateralized loan obligations. As of the making of this video, there's only 4 companies out there that invest specifically in CLOs, with the others being Eagle Point Credit Company, ticker symbol ECC, XAI Octagon Floating Rate and Alternative Income Term Trust, ticker symbol XFLT, and Oxford Lane Capital, ticker symbol OXLC. A CLO is basically a pool of leveraged corporate loans that are bundled together and put into equity securities, which companies like OCCI purchase. All of these CLO funds typically offer much higher dividend yields than most investments out there. That's because these funds typically buy the riskiest CLOs out there because they're much higher yielding than others. On top of that, the amount of leverage that CLOs use can be pretty high, which can either magnify gains or losses depending on the economy and how well the management team's been doing. These investments are overall a little more complicated than others, but Eagle Point Credit Company has some pretty insightful information available. You can see the market for CLOs in the US has continued to grow over time, and they now make up 52% of institutional leveraged loans. From 1992 to 2022, the Credit Suisse Leveraged Loan Index has generated a positive total return in 28 of the past 31 full calendar years. Judging by this information, we can see that CLO investments can be profitable, but if that is the case, then why has OCCI's share price been falling since their IPO? So let's take a closer look at OFS Credit Company and try and determine why that might be the case. They release a document called a fact sheet every quarter, which is a good introduction to their company. There's a few things that stand out to me on this thing. The first is that insiders own about 6% of all outstanding shares of OCCI, which is really surprising to me. This is much higher than average compared to other common shares I've seen. So despite their bad performance, insiders are choosing to remain optimistic about OCCI's outlook. Their top 10 industries are pretty well diversified across a lot of different sectors, and their top obligor makes up only 0.7% of their investment portfolio. So in terms of diversification, things look pretty solid here. When we get to their S&P rating distribution of underlying obligors though, we can see the quality of their investment portfolio. The vast majority of the investments OFS Credit holds are rated in the lower Bs and the upper Cs, with 3.9% being unrated. All of these investments would be considered to be speculative investments by Moody's as well as Standard & Poor's. Speculative investments are investments that carry a significant amount of default risk. If you regularly watch my channel, you know that there have been instances where a high-yielding investment might see a significant drop in share price, but because of the high dividends, it's actually been a profitable investment. An example of this would be the Cornerstone Strategic Value Fund, ticker symbol CLM. Despite losing almost 95% of its share price over time, if we run it through a drip calculator to determine the total return of a holding with dividends being reinvested, we can see CLM has still been a profitable investment. That's because of the massive dividends the CEF has been able to pay to shareholders. It's not a great return by any means, but I think this surprises most people that an investment like this could still deliver a positive annual return. So you might think that OCCI could be worth it considering the dividend yield is much higher than CLM's. But unfortunately, that's not the case in this situation, as we can see this fund has provided a negative return since its inception. It's provided an average annual return of minus 3.34% with dividends being reinvested. A $10,000 investment in this stock would only be worth about $8,400 as of the making of this video. Honestly, considering the fact their share price has fallen by over 60% since its IPO, I honestly expected things to be much worse. But still, it definitely has not been a positive investment since their launch. So with this in mind, could this company ever see a recovery? While trying to dig deeper into this fund, I ran into a bit of a dead end that I think would have provided some very valuable information. I remembered back to that bar chart that showed the Credit Suisse Leveraged Loan Index and realized something. I've seen these CLO funds reference this index to prove that CLO investments have been profitable over time. You can see according to this chart, CLOs have provided an average annualized return of 5.5% since '92. But as we just saw, OCCI hasn't returned anywhere close to 5.5% per year. I did my very best to try to find a list of what's included in this Credit Suisse index, and I just couldn't locate hardly a thing about it on Google. Not even Credit Suisse appears to have a page on its website dedicated to this index, which I think is really weird. So I don't believe this chart is a good reflection as to what to expect from CLO funds like OCCI, ECC, and others. Ultimately, the biggest influence in terms of OCCI's performance, I believe, is the management team's ability to pick good CLO equities. Let's look at their most recent fact sheet again and compare it to how their portfolio has changed over time. Keep an eye on the bond ratings at the bottom. Now let's compare it to a year ago. In the last year, they've been acquiring more investments that are even more poorly rated. This could help explain the rising dividends despite the falling portfolio value. Remember, the lower the rating, then typically the higher the interest payments that come with it. This isn't a good sign from what I'm seeing, and in fact, insiders have been making up a lower percentage in terms of stock ownership. With these things in mind, I don't know how OCCI is going to be able to improve things. The share price continues to fall, and I'm not sure how they'll be able to transform themselves into a more profitable fund unless they make some serious improvements to their investment holdings. But with that being said, that's going to conclude today's look at OCCI. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.